What does the participation rate do in an annuity? Hey, good question. Kind of triggered me a little bit because we're talking about indexed annuities and how that all works. Hi there, I'm Stan, the Annuity Man, America's annuity agent, licensed in all 50 states and Puerto Rico, pioneer of contractual guarantees only, top agent out here. And so I do understand the index annuity jargon. I've written a book on it. I'll tell you how to get that as well for free after this. So participation rate. What does it do? In essence, in English and Southernisms, it limits the return. That's really what it does. I mean, with indexed annuities, fixed index annuities, you have a couple of levers. Caps, spreads, and participation rates. Now, I've done specific videos on those, which you can pull up on my YouTube channel. But what I'd rather you do first is go to my site, theannuityman.com. I've written owner's manuals on all products, and I have one on indexed annuities. And in that indexed annuity owner's manual is a very good explanation of all of these levers: caps, spreads, participation rates within indexed annuities. Now, let's do some back history on all of this, because that's a pretty interesting question. It smells eerily of a bad sales pitch or a presentation at a bad chicken dinner or expensive steak dinner seminar, but you need to know kind of the background. In 1995, indexed annuities were introduced as CD products. I did that on purpose because they're not market products. They're not securities. They're a fixed annuity designed to compete with CD returns. And guess what's happened since 1995 in the biggest raging bull market of all time? CD type returns. That's fine. It's a principal protection product that provides CD type returns. That's not how it's sold. And when this question is asked about participation rates, it kind of triggers me, because I can just hear Johnny Appleseed agent going, yeah, you get market upside with no downside. You get market participation with principal protection, and you get an upfront bonus. I mean, I can just hear it and going, oh gosh. I mean, such garbage. What you also need to know about indexed annuities, at the time of this taping, hope they change, is that the annuity carrier, life insurance companies issue annuities. They issue indexed annuities, and indexed annuities are regulated at the state level because they're a fixed annuity, and it only takes a life insurance license to sell them. Okay? And in most states, you got to make a 70. So most people off the street could do that. That doesn't mean, that means, I always say this, you could pass the test on a Friday and then give a seminar the following Saturday, and someone make a decision to give you their life savings and put it in indexed annuity. Somehow, I don't know how that works, because I have a pretty extensive background with Dean Witter, Payne Webber, Morgan Stanley, and UBS. So I understand financial products. I understand true growth. I understand markets. I understand options and futures. I understand all of that. But I also understand how annuities work. The other thing, the kind of a loaded answer to that very simple question about participation rates. Currently, at the time of this taping, check the date, there are over 800 index option choices for fixed index annuities that include participation rates, spreads, caps, whatever. But the point is, those are typically can be changed with most policies, most index annuity policies. The carrier can change the way those gains are calculated with those caps, spreads, and participation rates. Wait for it, at their discretion. Give you an example. Let's say, just say you bought an indexed annuity that has a 1-year option, okay? So every year it changes. So you buy an indexed annuity with a 10-year surrender charge. A lot of them have 10-year surrender charges. So what have you really purchased? You've purchased a 1-year guarantee, and the other 9 years can change at the carrier's discretion. That's not all indexed annuities, but that's a vast majority of them. What I'm trying to tell you is, if it sounds too good to be true, it is every single time. If you're going to do market growth, don't buy an annuity. Now, I just got an email. I was checking my emails in between the break, and one of the questions I got is, what's the best company to buy an indexed annuity or a RILA from? RILA is registered indexed linked annuity, which is what the brokerage firms are selling to combat the index annuities so that they have something to sell. My answer is neither. I mean, if your goal is market growth, don't buy that. Go buy the market. Go have a fee-only advisor manage your money. Notice I said fee-only. Fee-only advisors don't sell product. They manage your money. Fee-based sell product. They double dip. I'm not saying they're bad people. I'm just saying be careful out there. All right? If it sounds too good to be true, it is every single time. And RILAs, to me, I don't sell that. I'm not securities licensed anymore, but I was, so I do understand them. I call those copay annuities. You say, well, wait a minute, copay? Yeah, what you're doing is you're choosing how much downside that you're going to participate in, and you pay for that right. How about that? Who thought that up? Only a brokerage firm could think that product up and go, you know what? Let's charge them. Who? They're like, who? Charge who? The client. Let's charge the client to share in the downside. You think we can get away with that? Yeah, I think we can. I mean, and honest to goodness, they're as hot as a firecracker, I guess. That's what I hear. Not in our world, because in my world, it's contractual guarantees only. You own an annuity for what it will do, not what it might do. So since 1995, when indexed annuities were first introduced, and just recently, RILAs have been introduced as the brokerage combatant to the indexed annuity. I guess they're twin brothers, I guess that would be the way to do it, big C behind the camera. But regardless, you're talking about participation rates and caps and spreads and levers, and all those levers do are limit the upside. Now, if you're an agent and you don't believe that and you want to yell at me, that's fine, but I'm right. It limits the upside. Now, the pitch is, well, there ain't no downside or limited downside on the copay annuity. I understand that, but why not just go get the growth? Why not get it all? Because with indexed annuities, whatever index you choose, wait for it, does not include dividends. And you say, well, who cares? I don't care about dividends. Well, the S&P 500, over 50% of the returns historically have been based on the dividends. Okay? So, also too, with most, not all, most indexed annuities, you get to lock in the gains every year on the contract anniversary date, which means you're an absolute annuity eunuch. Write it down, those other 364 days. Now, there are some weird little index annuities that allow you to do this, but the vast majority, you're slave to the day, as I say. Please tell me how that makes sense. Why not just go market growth? Why not have liquidity? Why not do something that could get you real upside? You cannot have your cake and eat it too. And if you can't explain it to a 9-year-old, no offense to 9-year-olds, do not buy it. And if it sounds too good to be true, it is every single time with annuities without exception. Period. End of story. And just to pile on a little bit, because I do hit after the play, I've yet to see a proposal from any of these index type products that came true or that were better than what was pitched. Ever in my life. The only possibility was the one in 1995 when they first came out with Keyport Life. I used to call it Keystone, but remember, Keystone was a very cheap beer, so when I was drinking back in the day, and I don't drink now, I'm 20 years sober, there was something called Keystone Light, but I digress. The company was Keyport. They were the first ones. Maybe that one beat the proposals, but I don't think they were doing back-tested numbers and all this unicorn chasing butterfly and all that stuff that you hear now with upfront bonuses. By the way, and I'll close with this, there's not a philanthropist at an annuity company that wakes up in the morning and goes, you know what? I am so patriotic right now that I'm going to do an upfront bonus, free money, and I'm going to do the best participation rate pro-consumer that I can do. They're not doing that. They are not doing that. I have a very good friend that's on boards of some of these index annuity companies, and he comes out of those meetings saying, oh my gosh, Stan, you wouldn't believe what they said. I'm like, of course I would believe what they said. So to answer the question, I know I went all over the place, but it was organized and I did stay in my lane. Participation rate, schmate, who cares? If you need market growth, don't buy these things, all right? Do me a favor, there's a video that's apropos, as they say, Above my head, click that. It's about contractual guarantees only. I am the pioneer of contractual guarantees only. And only recommending the contractual guarantees, never ever looking at potential and hypothetical and theoretical. Unicorns chasing the butterflies. You own an annuity for what it will do, not what it might do. That video explains why that's important to us and why it should be important to you. My name is Stan, the Annuity Man. See you next time.